Right, brilliant guys. Thank you for attending this webinar today, where we'll be examining the effects of market volatility on trader performance. Before we begin, there are some prerequisites for today's webinar, and I'm just going to switch to full screen here and go through those with you. In terms of prerequisites for today's webinar, it is assumed that you have knowledge of the DWC Darwin asset, that you have an understanding of market volatility, and that in general you have an understanding of correlation and portfolio construction to some degree. That could be for any assets. It could be currencies, stocks, commodities, Darwins in general. The idea is that if you have an understanding of correlation and portfolio construction, you should be more than fine with the contents of this webinar today. Might I please also ask you to, if you have any questions, that I'm sure you will, to please keep those questions for the end of the webinar so we can get through all the material in time. We have approximately 30 minutes for this presentation. And once we're done, I will invite you to a Q&A session where you can please exercise all questions that you've been waiting to ask. Moving on to the agenda for today, in terms of what we'll be discussing, obviously trader performance versus market volatility. We'll start off with some community observations based on our own data, what views and behaviors we've observed in the community, and in particular the community's attitude to volatility in general, their perceptions, attitudes, and engagements when it comes to volatility. We'll discuss those. Based on that, on those observations, we'll talk about some questions that are naturally raised as a result of analyzing those behaviors, and those include: should traders prefer high or low volatility? Depending on each situation, high or low volatility, how should they react in each of those settings? Once we've discussed those observations, analyzed some questions that are raised as a result of those observations, we'll go on to examine volatility and its impact on trader performance in a two-part study. In the first part, we'll simulate volatility. We'll construct an appropriate data set that we will then analyze for volatility. It will allow us to form some conclusions on how volatility generally behaves. And in the second part of the study, we'll go on to compare trader performance in the Darwinex community versus high or low volatility, the observations that come about as a result of that comparison, and we'll go on and analyze those observations and put forward some conclusions to the same. So moving on to the first bit of today's presentation, observations. This will be fairly brief. In our community data at Darwinex, we've observed that traders generally, all around, believe that high market volatility presents a greater number of trading opportunities. This is a fairly common perception as regards market volatility, and traders, particularly in foreign exchange trading, assume that high market volatility presents a larger number of trading opportunities. Now, what we did in that respect was take this perception and analyze it quantitatively as well as fundamentally to see if it is valid. Is it true? Secondly, if it is true, what are the actual impacts of high market volatility on trader performance? So from a quantitative as well as fundamental perspective. The questions that were raised as a result of this perception are, well, firstly, why does the notion exist? Why do traders believe that high market volatility brings along with it a larger number of trading opportunities? Secondly, is there a way for us to study this volatility, and what are its effects on those same traders who believe that high volatility brings additional trading opportunities? We follow on with figuring out, in general, should traders be preferring high or low market volatility, and we finalize it with how should traders react to high or low market volatility. In this webinar, we attempt to demonstrate, as I said, what actually happens during periods of high market volatility. So the first part of the study, examining volatility, we need to do a few things prior to making assumptions, analyzing the data set. We need to first create the data set. In order for us to do that, we decided that to create a data set on which to study volatility, we would need to use an equally weighted portfolio of assets that, when we calculated volatility on, that volatility generalized well to the last 12 months of actual market volatility. And the portfolio, since we're talking about Darwinex trader community performance, that portfolio would have to be composed of currency pairs, since a large majority of the Darwinex community trades foreign exchange. So firstly, starting off with the data set, we're going to use an equally weighted portfolio of currency pairs that allow us to generalize volatility well to actual market volatility. And the choice of currency pairs is because the large majority of the Darwinex trading community trades foreign exchange. In terms of the composition of this equally weighted portfolio, we decided to use the NZD CHF, GBP JPY, AUD USD, and Euro CAD currency pairs. And there are two simple reasons for the choice here of these four particular currency pairs from the roughly 50-odd currency pairs available on the Darwin Exchange. And the reason is that each constituent currency in these pairs covers the full spectrum of 8 currencies that the entire Darwinex community trades. What that means is, if you notice the composition of these pairs, it's NZD CHF, GBP JPY, AUD USD, Euro, and CAD. Those are the 8 individual currencies to which the Darwinex community is exposed at any given time, given their preferences in trading. So that was the reason we chose these 4 assets. It doesn't matter, this in terms of the choice of assets, there are plenty of other combinations of assets that you could have chosen. But at the end of the day, we believe that this particular choice allowed us to cover the full spectrum of 8 currencies that Darwinex community traders are exposed to at any given time. The plus and minus signs that you see on those currency pairs indicate how we structured the portfolio in order to sort of make it a reasonably balanced portfolio. And the plus and minus signs basically indicate whether the pair was considered to be long or short when we were calculating volatility. And I will show you exactly how we calculated volatility. It's a fairly simple process later on as well. In terms of the actual measure for volatility, how we went about measuring volatility on this synthetic or simulated portfolio of assets was a very simple rolling 21-day standard deviation of returns. And in this study, our focus is not on short-term volatility, it's very much on long-term volatility. Therefore, we use daily returns instead of any smaller time frames. So the portfolio of assets that I showed you earlier of NZD, CHF, etc., all of them we used daily close prices in order to make our volatility assessment, our calculations. The long-term focus also means that we don't consider any short-term volatility changes that may cause brief fluctuations in the market that obviously affects volatility, but intraday. We're not focusing on intraday, we're very much focusing on the longer term. And such events, for example, include the NFP or FOMC or any other major news release or any other unforeseen event that causes a large swing in volatility. We do not consider those in this analysis. It's very much a long-term affair with a time window of 21 days. That is one representative of long-term volatility. And secondly, 21 days is quite representative of the number of trading days in a month as well. So those were the reasons behind using behind the long-term volatility, and secondly, how we went about creating the windows of time to calculate the volatility. And once we're done constructing this portfolio and calculating standard deviations of 21-day returns on them, the portfolio looks, the volatility presents itself as you can see. Cyclical behavior range between 0.16 and 0.3, and of particular interest is how much it changes over this brief period of time that we've taken it on. We've taken it on the last 1 year's worth of data, and you can see that the swings between 0.16 and 0.32 roughly indicate that the volatility is changing over this brief period of time in this currency portfolio by roughly 50% each way. So the moral of that story is that traders who prefer higher volatility as representative of a larger number of trading opportunities are at the end of the day faced with this profile of volatility. This particular portfolio of assets generalizes well to actual market volatility, and it therefore means that those same traders are up against this level of volatility. It fluctuates quite aggressively, as you can see. Now, moving on to the second part of the study, now that we have successfully constructed the portfolio that allows us to measure volatility, we've our choices in determining the portfolio and the way we measured volatility using daily returns instead of any other shorter time frame, that allowed us to simulate what volatility looks like and what traders face. The second part of this study is to compare how trader performance measures up against that volatility. In order for us to do that, we need to look at something that allows us to basically see what trader performance is like. So an asset that is representative of trader performance is necessary here. And on the Darwin exchange, that asset is the DWC Darwin. So the DWC Darwin, as you know from previous webinars and blog posts, is representative of the community's trading performance, and the particular cycles in the DWC are representative of how the community is either prospering or suffering at any given point in time. So from previous webinars and blog posts, you'll know that a rise in DWC indicates underperformance in the community, and a fall in DWC, the middle portion of this chart, as you can see, a decline in DWC's performance indicates that the community is doing really well. So this asset serves our purposes really well in the quest for comparing trader performance versus volatility. So we now, from a studies perspective, we have two charts. We have the first one where we created the volatility series and visualized it on a chart. This second one is a chart of the DWC Darwin that is representative of trader performance. So now for our study, we have both available to us now. We know what trader performance looks like over the same time period as the volatility we measured earlier on. And when we layer them over each other, when we overlay them, this is what the comparison looks like. And it's fascinating to see that there is a very strong positive correlation between the volatility that we calculated earlier over this same time period and the DWC's performance over this same time period. Now remember the description I reiterated earlier about what the DWC represents. The DWC is the orange curve in this chart, and the volatility we calculated earlier on with that portfolio that we constructed is the blue curve on this chart. Layered on top of each other, you can see that they both behave almost in similar fashion. They're both, as in they are both strongly correlated. And if we go back to the fundamentals of the DWC rises when the community is underperforming, and the DWC falls when the community is performing. So now when you compare it to the volatility curve, the blue volatility curve in this chart, you can see that as volatility declines, the community performs well. But as volatility increases, the community underperforms. Once again, this is a lot of material to cover, so we'll quickly step through it all over again. We know volatility from our calculations earlier, and we've taken the DWC's curve as well because it is representative of trader performance. Both have a positive correlation, which means that they both move in line with each other to some extent, to a reasonably strong extent based on this result. When volatility is declining, DWC is declining, and we know that when DWC declines, the community prospers. On this chart also, when volatility is increasing, DWC is increasing, and we know that when DWC increases, the community underperforms. So the observations here are that positive correlation between portfolio volatility and DWC is indicative of the trader community progressively underperforming with increasing market volatility. If we go back to the very beginning of this webinar where we talked about the observation being that most traders would prefer higher volatility or at least most traders perceive higher volatility to be a time that brings forward a larger number of trading opportunities. Based on our analysis, based on this study that you've observed, it's quite apparent that positive correlation between portfolio volatility and the DWC indicates that when volatility increases, traders underperform. And liquidity providers are the only ones benefiting from such an activity. So liquidity providers benefit the most during periods of increased market volatility because traders suffer during those periods. So any money the traders are losing is, of course, going to the liquidity providers. And in such times, based on what we've discussed in previous webinars and blog posts about DWC in general, the DWC as an asset is an asset that's good for hedging portfolios in these situations to mitigate the effects of high volatility. High volatility bringing forward risk, as our analysis shows that as volatility increases, DWC increases. We know that when DWC increases, traders underperform. So it makes sense to hedge some of that risk with DWC during periods of high volatility. Moving on to some conclusions as to why we've done this study and what this study means to traders. We've now observed that increases in volatility cause decreases in trader performance and vice versa. So it's therefore always a good practice as a trader to measure your volatility. Always compare your strategy's returns, whatever your returns curve is. You may have Darwins, you may have a strategy you're trading without a Darwin. It doesn't matter. At the end of the day, if your returns are positively correlated with volatility, there's nothing to worry about, or very little to worry about, because your profitability or your losses are in line with market volatility. So market volatility is therefore not affecting your returns. However, if you are not positively correlated with market volatility, you need to keep an eye on your use of leverage, especially during periods of low volatility, because low volatility naturally invites traders to use more leverage because seemingly short or small movements make the use of leverage more appealing. So small movements, leveraging trading allows for using larger amounts to leverage smaller movements. But what happens as a result is when the market eventually does turn, when volatility does turn from declining to increasing, it usually does that very, very quickly, as we can observe from both the volatility analysis we've just done, where you can see as volatility declines, when it does rise, it rises fairly fast. And the same is the case with the DWC. As it declines fairly slowly, but when it rises very, very fast. So the whole comment about use of leverage, keeping an eye on it if your returns are not positively correlated with market volatility, is because you may be using leverage as market volatility declines, but the moment market volatility rises very, very quickly, that leverage, use of excess leverage will turn against you and cause asymmetries in your own exposure, which will most likely work negatively. They will work against you and are likely to cause severe damage very, very quickly. In terms of how the volatility graph was constructed, I really should have had this slide a little earlier on, but now that we're here, the actual construction of the volatility graph that we showed you earlier, involving NZD-CHF, GBP, JPY, AUD, USD, and EUR/CAD, involved using end-of-day returns using close prices. So you construct a table of returns using close prices, end-of-day close prices for each of those currency pairs. You then, for each row of returns in this table, you calculate the sum of returns based on this particular direction pattern that we've proposed here, negative NZD-CHF plus GBP-JPY plus AUD-USD minus EUR/CAD. Sum those all together with those directions and divide by 4, because there are 4 assets in consideration here. Once you now have this new series of returns, you basically calculate and plot a 21-period standard deviation. If you find what I just said to be too complicated, that's okay, because the follow-up to this webinar will, by next week, we will produce 2 pieces of code. One will be pseudocode that allows you to see this calculation, so you can do it in things, for instance, like Microsoft Excel or any other sort of spreadsheet application. And for those of you who are programmers, we will release MQL code that will allow you to basically construct this portfolio and chart it inside MetaTrader 4 if you would like to follow market volatility along with your trading. So we will release those 2 things. They will be released as a follow-up to this webinar by middle of next week. Some further conclusions on this whole study are that you've observed that volatility and DWC are positively correlated. So if you would like to trade volatility, if as a trader you would like to trade volatility, it makes sense that you would trade DWC, because volatility, as we've established, has a strong positive correlation with DWC. And what's also visible from the charts that we observed earlier are that DWC's movements lead market volatility, which means that swings in DWC, they precede those of market volatility. So if you see an upturn, for instance, from a decline in DWC, if you notice that it's turned up, it's likely that market volatility that has been declining will be turning up again in future based on this observation. So it's a very powerful leading indicator. However, there are some drawbacks to making that statement. And the drawback is that currently we have data for DWC only from September 2016. We are aware of this. The data set is therefore only a year long. And while the fundamentals of DWC are sound, this gives us confidence in DWC and it gives us confidence in this volatility study. Particularly given that DWC trades the opposite of community-driven asymmetry and currency exposure, we are confident that this behavior will continue into the future. However, as we have a limited data set that spans a year, we will be gathering more data as more data comes in from the DWC and, of course, the market with those currencies over time, and we will repeat these studies over time. So our objectives there will be to ensure that, firstly, our analysis is consistent, that and that any changes in behavior that present themselves, that we can take them into consideration and analyze and repeat studies accordingly. So we are aware that we have a limited data set, but we are confident in the fundamentals that power the DWC, and therefore it's very likely that this behavior will continue into the future, but we will be monitoring it and presenting you with repetitions of these studies with new data over time as well. So I hope you've enjoyed this rather technical but a webinar about a fairly interesting topic, the effects of market volatility on trader performance. And I thank you for your patience and for your attention. And now we will move on to Q&A. So if you have any questions for me, please, by all means, ask away. I have a question here from Vitor. Negative NZD CHF means a short position, so plus AUD USD means a long position. Thank you. So Vitor, that's exactly correct. In terms of calculating returns, this particular portfolio used negative NZD CHF, which means that when you're summing the returns, you would take whatever the percentage return was for NZD CHF from day to day, and you would negate it, as in multiply it by -1 before adding to after that AUD USD. So plus AUD USD means you would just add the positive, the normal returns you experience for AUD USD. So in terms of a calculation for one row, that would look like whatever the return is. Let's say it's return 1. So you would do -1 plus whatever the return is for AUD USD plus GBP JPY minus Euro CAD. That's how you would construct the return for that position, and then you would, for that row, and you would then divide it by 4, as we have considered 4 assets. So you have to normalize your return by 4. I have another question here, again from Vitor. I was late today. Is this webinar being recorded? Yes, it is indeed being recorded, and we will be publishing the recording for you as soon as it is available. I have another question here where we're talking about how do you construct the portfolio? Why do you construct the portfolio as you did? So the reason for constructing that portfolio with those particular currency pairs was, as I explained earlier, the Darwinex community, 99% of the Darwinex community trades currencies. So the choice of those particular currency pairs, let me go back to the slide. I think that will make it a lot more intuitive. I'm just going to scroll back to the slide where we have that particular description. Okay. Oh yeah, here we go. So NZD CHF plus GBP JPY plus AUD USD minus Euro CAD. The reason for choosing these currency pairs was because each currency that forms the currency pair, if you look at each of them, spans the entire spectrum of currencies that the Darwinex trader community is exposed to at any given time. That was the main reason for choosing these particular assets. So negative NZD, CHF, you have NZD and CHF. Then in the next currency pair, you have GBP and JPY. And in the next currency pair, you have AUD and USD. And the final currency pair, you have Euro and CAD. If you look at all of these, this particular portfolio covers all 8 individual currencies that the Darwinex community is exposed to at any given time. Therefore, it made sense to use this portfolio as it spans the entire spectrum. And calculating volatility on such a portfolio would therefore generalize well to actual market volatility, which was the aim of this study. We wanted to compare what volatility looks like versus the Darwinex community's trader performance. Okay. How do you calculate volatility? Is another question. How do I calculate volatility? Okay, so we calculate volatility using a fairly standard measure. Rolling 21-day standard deviation of returns is what we've used as our measure of volatility. The choice of time window being daily is, as I explained earlier, because our focus is on long-term volatility and not on short-term volatility that's induced by movements that are induced by events like, for example, the NFP or the FOMC or any other major news release, or something that's unforeseen, like, for instance, North Korea firing a ballistic missile at somebody. Things like that cause sudden movements, that create certain risks and cause movements that were unforeseen. We're not considering those sorts of movements. We are most certainly considering long-term volatility, which is why we chose a year's worth of data on that particular portfolio of currency pairs, and we also chose a 21-day time frame to calculate volatility because A, it's longer term, it generalizes well to actual market volatility, and 21 days is a good sample that also represents the number of trading days in a month generally. So those were the reasons behind that. Regarding overall market volatility, what are the cross pairs being used to measure volatility? The cross pairs, and we have a question here from Vitor regarding overall market volatility. What are the cross pairs being used to measure vol? So the cross pairs, as I just explained, are being used because the main reason for selecting those particular currency pairs was to ensure that we covered the entire spectrum of currencies. So to put it slightly simply, if you look at the entire community, and the entire community is trading foreign exchange, or a very large majority of the community is trading foreign exchange, at any given time they are exposed to any of those 8 currencies. So they may be trading euro-dollar, for example, and when they're trading euro-dollar, their exposure is to the euro and to the US dollar. Similarly, for somebody trading, say, the Aussie dollar, their exposure is to the Aussie dollar and the US dollar. For somebody trading the euro CAD, their exposure is to the euro and to the Canadian dollar, and so on and so forth. So our choice of this particular equally weighted portfolio was so that we covered the entire spectrum of currencies we possibly could that the Darwinex community engages in. Does that answer your question? Excellent, excellent. We have, oh, you've already responded. Oh, okay, thank you. Fantastic. You guys have been a great audience. I really appreciate your time and patience and for your engagement. Seems like everyone was focused on the contents of this presentation. Thank you very much for your time. If you have any further questions, you're very, very welcome. No, it's always a pleasure coming on these things, presenting these Darwinex Labs studies to you, and we have plenty more that are cooking that we'll be coming up with over the course of the next few weeks. So thank you very much for your time. If you have any further questions, please feel free to email info@darwinex.com, and either myself or one of my colleagues will respond to you as soon as we can. Thank you for your attention. Take care and have a great day.